and we are today in discussion with Prashant Jain, CIO of Hello and welcome to this special coverage of the markets, and we are today in discussion with Prashant Jain, CIO of HDFC Mutual Fund. Prashant, always good to have you on the show. Thanks for taking time out. It's been a treacherous run for last 2 weeks or so. Not been a good year. Not been a start to, not been a good start to the year. But are the markets now entering a value zone from a long-term buying perspective? Would you advise deploying some cash at current levels?
I think if you look at the last 8 years to be precise, from Jan 2008 till date, the index is up only 20%, the large cap index, and the nominal GDP would have grown more than 120% over this period. So I think definitely the market cap to GDP of India is in a very attractive zone, and therefore I think the outlook for the markets over next few years, to my mind, is very positive. I have also seen that whenever the markets in India correct, driven by factors mainly outside India, these have proven to be great opportunities to invest with a 2-3 year perspective. So whether it was 2001, whether 2008, 2013, all these corrections were driven by external factors. I think the local economy is improving, fortunately, and I think next year we'll see the substantial impact of the lot of steps which have been taken in the last 18 months. So I am quite optimistic on the economy and on the markets going forward.
What if it is 2008? It may present great buying opportunity, but at what point? And is there a risk of 2008 playing out in terms of correction as well for global markets and for Indian markets?
I don't think so, because when 2008 took place, the largest economy in the world was in pain. Today the largest economy is doing quite well. So that is point number one.
Second largest has a problem.
And even in China, the problem is of slowing down. I don't think there is any need to panic about China. You look at their foreign exchange reserves, you look at, a lot of things. It's an incredibly strong country, very, very strong economy. It is just that the growth rates are moderating. And I don't think we should read too much beyond that into China. The second key difference is why it is wrong to equate this even remotely to 2008 is because before Lehman, the starting P's in India, the peak P's were 25 times.
Yes.
The markets bottomed around 11-12 P. Today we are already at 14 P. So even in the worst phase of panic in Lehman, you bottomed out at 11 P, and today you are not too far away from that. So I think any comparisons are quite misplaced.
Okay, last year was all about bottom-up stock selection. A lot of mid-caps did well, a lot of small caps did well, a lot of people's portfolios did well in 2015 because they were in mid-caps and small caps. Do you see that reversing now? And would you advise people to now look to the safety of large caps and move out of mid-caps and small caps?
So I think even though we have not timed it perfectly, but we have been saying for last 1 year or so, I think on several occasions one has said that the mid caps are relatively more expensive or less attractive than the large caps. I think what has happened is the earnings disappointments or earnings pessimism has been built into the large cap valuations. But I think the same, because of weaker price discovery, lesser research coverage, the likely earnings downgrades in many mid caps I don't think has really played out. So when I look at these markets, I feel the several large businesses have actually become mid caps because the market caps are so low, and several small businesses are trading like large caps because the valuations are so expensive. So I don't think this is going to sustain, and it is hard to justify a very significant premium for a company which is smaller in size. Having said that, I think the mid cap space is so large, it is so vast, that for someone talented, for someone who does enough homework, it should be possible to pick few good stocks here and few good stocks there. But as a group, I think next few years, to my mind, large cap should outperform mid caps.
Okay, and within large caps, where do you see leadership then? The market has struggled for leadership all through last year, especially in private sector banks. PSU banks, of course, we all know what has happened, but even private sector banks, barring a couple of banks, have been butchered. So from these levels, what do you think would lead the large caps?
I think the economy and the markets, to my mind, are in transition. So the economy is coming out of a very high inflation phase, very high current account deficit, a phase in which currency depreciated 40–50%, a phase in which capital expenditure was extremely weak, and a phase in which fiscal deficit was going up and it supported kind of consumption. The earnings growth was limited to very few sectors, basically linked to consumption or to exporters or to retail oriented banks. And therefore I think, since market always loves sustained growth, or wherever there is growth you tend to crowd in there, I think these sectors have become quite expensive to my mind. When I look at the next 1, 2, 3, 5 years, I think all these factors are changing. So high inflation has become low inflation. Your FDI inflows are more than the current account deficit of the country after a long time. Fiscal deficit is moderating, inflation is down, interest rates have come down a bit, I think they should go down more. And I think there are definitive signs about a strong recovery in capital expenditure over the next few years. I think it will be led by infra space, by government spending. Private capital expenditure will follow maybe after few quarters. And therefore, when I look at where the markets are today, I think they are in transition. Okay. I think the leadership in these markets will change. And I look at this fall as a process of that leadership change. So I think when markets recover, it will not be the leaders of the last few years which will outperform, but a new leadership should emerge. And I think these sectors will be related to capital expenditure.
This is one thing which I really want to know. We have Infosys again surprising on the upside. We've seen TCS hit 52-week lows. We've seen Infosys outperform. Is this cycle changing? Or it's already changed, but do you think it will change even more in favor of Infosys compared to TCS? Since you have investments in both, but my sense is that you have more investments in Infosys compared to TCS.
I think the way I look at this is both are great companies. But both while the business model is same, the details about clients, your exposure to certain geographies would be different. And I think it is a coincidence, or just by chance, that a particular company has some challenges in its sets of clients. And so I have seen in last 10 years, there was a time when Infosys used to trade at a massive premium to TCS. Yes.
This was 2006 probably.
2008,
yes.
6, 7, 8, it lasted for a few years.
Yes.
And if you go back 3 or 4 years, TCS was trading at a 30–40% premium to Infosys. And today again, both are at
same
par.
valuations.
So I think both are great companies, but even great companies can have some variations in performance depending on their clients, their exposure to geographies. I think, Infosys is coming out of a lean period of performance, and TCS has had very strong last few years. So I think there is something called mean reversion in life, and that is what we are experiencing here.
So can this mean reversion take us back to 2006 to 2008 phase where Infosys goes to say a 20 to 30 premium over TCS? And if that happens, does Infosys rally or TCS fall, or do both happen?
I think it would be extremely hard to say that, but I think the market always loves or gives more value to recency,
Yes.
to the recent performance. So I guess TCS is probably more owned by investors than Infosys, and if the performance of Infosys is better than TCS for a few more quarters, then it is logical to expect markets again, since they give more weightage to recency, that Infosys could have some premiums. But again, I would come back to the same point. I think both are great companies.
Okay.
When the going is not good for one of them, I think they are capable to bring in corrective measures, and that is why whenever one of the companies, either of the companies, is at attractive valuations, I think it's a good long-term investment opportunity.
Okay, we'll take a break at this point in time, but once we come back, we'll discuss a lot more sectors and the way forward for markets with Prashant Jain. We are discussing the big picture with Prashant Jain, CIO of HDFC Mutual Fund. The fund, of course, has 1.6 to 1.7 lakh crores as asset under management. So always good to get Prashant's view, and let's carry forward the discussion then. Would you be willing to take a contra bet on PSU banks right now? It's the most hated sector, but if your call is that we may have a bit of a sort of a valuation catch up or transition phase in the market, do you think PSU banks can be good value bets at this point in time?
See, I think I would like to just while the market focuses on the ownership more, I feel whichever bank in India, whether in public or private sector, has given money to infrastructure space, manufacturing space, there is pain there, and that is quite visible in the market. So we have invested in these stocks some time back. It was not the best of timing, but I think again, when I look at the next few years, I think we are probably at the end of the asset quality problems. So today we see substantial progress on the infra side. In fact, the asset quality pains have moderated quite a bit in the infrastructure space. The new pain has emerged from the steel sector.
Yes.
And that is where bulk of the concerns are in the marketplace. I think if imports can be controlled and if steel demand recovers, which I think it will starting next year very strongly, in 2 years' time I think the fortunes of the steel industry will also change. So I think the asset quality pain is linked to economic cycles, and we are coming to the end of it. So I would be very surprised if the corporate banks don't outperform in these markets over the next few years.
The devil's advocate argument here would be what's happening in China, and we have further devaluation from yuan in yuan, and the steel industry crying for more and more anti-dumping measures. In that kind of environment, how will steel companies make money? We've seen over the last few years how things have panned out. Are you taking a contra call over there in that case?
See, I think what you are saying is right. No one can fault you for saying that the steel is in significant excess supply in China. But let us not forget that Indian companies have a significant cost advantage over the Chinese companies. So if Indian companies are making a small amount of profit, I am sure many companies in China are making losses. So, if you look at the iron ore mines in China, the underground mines have a very high cost structure. So these mines cannot sustain at the current prevailing ore prices. So some of this capacity will have to go out over time. So I think India has a natural significant competitive advantage in steel, and that is why the future of this industry is good. And I think, in my opinion, given the large needs of the steel industry in India, steel demand in India, given the competitive advantages that we enjoy, given the large employment that it can create, it can support Make in India, for example. I think the government will at some point of time support this industry against unreasonable competition, and it is nothing, not unique to India.
Collapse of crude, we have now 20 something on Brent. Who would have thought that was possible, right, at 120? Is it now hurting India more than benefiting India? So far, last year we all talked about the macro benefit to India, and that's played out. But are we now at a stage where the risk of global recession is hurting India, and crude is actually, you would rather see crude go back to 40 to 50 than stay at 20 to 30?
See, one is, I think, it just tells you once again how hard it is to forecast commodity prices. When crude was 140, people were saying it is going to $200, right? Yeah. So I think these are very sobering reflections to how hard it is. I would not agree to what you said.
Okay.
The lower the crude goes, the better it is for India. It is better for our current account. It is better for our fiscal. It is better for the consumer. But I think what we would ideally want is some stability. If it grows to $20 and then it rallies back to $60, I don't think that is good for us. I would rather it stabilizes at $30, $40. Okay. I think these prices are quite comfortable for India. And what we need is stability and not too much volatility, because that impacts the calculations of the regulators, the government. But as I said earlier, these are market-driven prices. So you and I can wish for anything, but ultimately it is the markets which will decide where crude is settling.
Okay. Since we're talking about crude, we have to talk about the sector of this year or for the last 3 or 4 months, which has been aviation. We have had a new listing, the largest player has listed, and that's provided a valuation benchmark. As a fund manager, are you interested in looking at aviation at current prices?
I would like to pass this. I would not like to comment on individual sector valuations, but I think it's a great growth sector, because the number of people who can potentially fly in India is very large compared to who are flying today. And the drop in oil prices has made air travel more affordable. But I think capacity addition in this sector is again extremely easy. So unless the market grows at a very high sustained growth rates year after year, I think there could be disappointments in profitability somewhere along the way.
Okay. Let's get back to the larger market thesis then, Prashant. All through last 6 months, we have seen FII outflows, and we have seen DIs, sort of contributing or at least supporting the market. A lot of this is SIP investment. So which is more stable compared to, say, direct investment in stock market from retail? Would you expect this SIP inflow to continue, or is that at risk given the way the markets have panned out, and given the way global markets have been unstable, and there could be a bit of a risk factor over there?
But I would hope, and I would suggest strongly that this is the good time to increase your SIPs. Okay. So as I was saying earlier, whenever in India we have seen markets correct around reasonable valuations driven by external challenges, these have proved to be great times to invest. So I think the Indian investor is also realizing, even though slightly belatedly, the attractiveness, the charm of equities. And I think what is happening is simply the maturing of the investor. And let us not forget, what is the industry collecting today? It is collecting $1 billion a month, $10 billion a year, $12 billion a year. That is 2% of India's household savings. We can buy gold worth 30, 40, 50 billion dollars a year, which gives you inflation-linked returns. And when we are collecting $10 billion in equities, it seems very large. Actually, it is very small.
Okay.
It is just that we have not looked at or understood equities the right way. I think these numbers have the potential to grow much bigger over time.
Do you see an equity cult developing then for retail audience?
I would not like to use the word cult, but I think the Indian investor is understanding equities a lot better.
Okay.
the distribution has become a lot easier. All the banks, who are not selling, mutual funds 10, 15 years back, they are beginning to sell. If you look at the papers today, State Bank has launched its wealth management business. If State Bank starts selling equities, you can imagine what will happen over time.
Okay, so then last question then, since you sound like you're quite positive on the large caps, and that is where you'll expect the next round of market rally. Would it be fair to say that once this global mayhem settles down, our markets could make a move back towards the previous highs in the second half of 2016 or first half of 2017? Would that be a reasonable argument or a reasonable assumption?
See, equities are an asset class where the longer term is known with greater certainty than the shorter term, where the destination is known with greater certainty than what way the markets will take to reach there. So it's hard to say where the markets will end in 2016, but if you look at the if you leave the time frame open, I think the economy is recovering very nicely. I think next year the improvement in capital expenditure will surprise most people. India's current account, FDI, fiscal deficit, all indicators are in very good shape. And markets are where they were 7, 8 years back, broadly. Profitability of lot of sectors is stressed. This will normalize. So I think the future for India, the future for equities is very good. But let us not try to put a number, because then it takes you away from the big picture. So I would simply suggest to people that whatever is that portion of wealth which they can spare for 2-3 years, on which they can financially and emotionally tolerate some volatility, invest that in a few good funds and be patient. To make serious money in equities, all you need is patience.
Okay.
That's all that you need. There are funds which have made money 30, 40, 50 times in 20 years. What was needed? It was just patience. So move away from the daily, weekly, monthly, quarterly, 5, 10, 15% up and down. Allow your equity investments to compound, because compounding takes time.
Yes.
And I think India is a great compounding story.
So the destination is beautiful, but the entire drive might not be picturesque. There could be in between roads where you'll have speed bumps and you'll have to be careful.
But
you'll have to,
that's true for life in general as well.
That's true of life in general. Prashant, thank you so much for dropping by and talking to us. So that's the view from HDFC Mutual Fund. Bullish on the market from a long-term perspective, but of course, the near term is still challenging.
The first 12 days of January have The first 12 days of January have been absolutely gut-wrenching for global and local markets. first 12 days of January have been absolutely gut-wrenching for global and local markets. To make sense of all of it and how it might still pan out for the year, my guest today on the show is Neem Kumar of IIFL. Neem, very good to see you after a long time. What a start to the year we've had. It's just panning across the board. All hell seems to have broken loose. How do you think this year will pan out? How big is this global problem that we are grappling with today?
Actually, Udayan, we should just take a step back and look at what happened in the past 6 months. There was a build-up to this, what is happening today. Slowly it was happening. But, for an equity market investor, there are three key drivers. I mean, one is cost of capital. The other is return on equity, the trends in return on equity. And the third one is, of course, the earnings growth. Now, look at this. Last 6 months, the earnings downgrades that we have seen has been one of the highest in recent times. So, if you look at FY17 EPS numbers for our index and what the estimates were in FY13 and the current EPS estimates today, they're almost 30% lower. So, that big tailwind that was needed is definitely not there. The second thing is cost of capital. I mean, Reserve Bank cut rates by 125 basis points last year. Long bond yields are almost there where even before the rate cut, the rates that were there, the rates are there today. So actually the yields have not come down, long bond yields, and that doesn't help the costs. And the risk premia in an environment where none of us are able to predict commodity prices, earnings of companies, currency trends, how credit spreads will behave, it's natural that risk premia widens. So it's been gradually widening and it had to give way at some point in time. I think looking back into the history, we've not seen the worst there because when there is a sell-off in credit markets, the equity risk premia widens very sharply. And the sensitivity of marginal changes in cost of capital and equity risk premia on the fair value of the market is very, very high. So cost of capital is widening. And the third one is capital efficiencies. I mean, few of us look at long-term trends in terms of, where ROEs of companies are there. And it is at our own peril that we don't see these numbers. Now, the return on equity in 2007 over the cost of capital was over 10 percentage points. Today, actually, the return on equity is below cost of capital, cost of equity. And therefore, if you actually look at all these three parameters, there is a justifiable reason for the derating of the market. Now, for the year, the outlook remains very challenging, notwithstanding the bumpy start that we have had this year. I don't see things bottoming out anytime soon, simply because of the fact that you could well see newer and newer geographies getting engulfed into this crisis. Last year was, the Russian economy shrank by 40% in dollar terms. The Brazilian economy shrunk by 25% in dollar terms. And now, there's a genuine worry as to what is going to happen in Middle East. And therefore, when you look at all these parameters, it looks like it's going to be a very challenging year for generating returns. And I'm not so sure whether risk will be adequately rewarded and the valuations are not attractive enough, for us to jump in.
Excellent points you make, Neem, and I'll pick on all of those. But let me start with the last point that you make, because that is really what people are grappling with. After a correction of about 15–17%, have valuations cooled off enough for people to start buying? Or would you say, looking at long-term history of difficult periods in the market, which you described, valuations can actually contract far more before they bottom out?
I think there is a risk that valuations will contract even more from here. See, Udayan, look at